Let me start with a simple question. Is most of your money sitting in the stock market right now? If you're like most doctors, lawyers, or executives, the answer is probably yes. Your 401k, index funds, maybe even individual stocks. The problem? All of your wealth is tied to the same market. And to be fair, that's exactly what you've been told to do your entire career. Max out your 401k, buy index funds, hold them long term. You probably even heard the saying, BT sacks and chill. But here's the question most people never stop to ask. What happens if the stock market drops by 50% tomorrow? And more importantly, what if the market doesn't recover for a long time? Because that's not a theoretical scenario. After the dot-com crash from 2000 to 2012, the S&P 500 didn't grow. In fact, it shrank. Think about that for a moment. More than a decade of working, saving, and investing, and instead of your wealth growing, you end up with less than you started with. How would you feel if the next 10 years look like that again? I've lived through exactly that kind of market. During the 2008 Great Recession, the S&P 500 fell by about 55%. I remember watching friends and colleagues, people who had done everything right, suddenly realize that half their portfolio was gone. Some had to postpone retirement. Some never fully recovered because they were forced to pull money out when the market was down. And here's the hard truth. If all your money is in the stock market, you're one correction away from learning that lesson the hard way. That's exactly why I want to walk you through how to protect your wealth from the next stock market crash. And I'm going to show you the moves you could start making today to make sure that you're not fully exposed to a single asset class. By the end, you'll understand why traditional investing advice just doesn't work, especially for high-income earners. What savvy investors are moving into right now, and how you can start building real protection and predictable wealth outside of Wall Street. Before we talk about how to protect your assets, we need to look at where the market is right now, because context matters. Stock market valuations today are sky high. Andrew Ross Sorkin, who wrote 1929, Inside the Greatest Crash in Wall Street History, has been pretty blunt about where we are right now. He said that prices today may not feel sustainable, and while he's careful to say he can't time the market, he's also been clear about this part. We will have a crash. I just can't tell you when, and I can't tell you how deep. Now that's not coming from some random person on YouTube. That's coming from someone who has studied market collapses for decades. He's seen prices keep going up and up, but they don't do it forever. What we're seeing right now is prices going up much faster than company profits. The businesses that make up the stock indexes aren't growing as fast as their stock prices. When that gap gets big enough, it eventually closes. And you can feel the optimism and excitement around AI. Companies are racing to invest. Investors are piling into anything connected to it. There's a sense that this is a once-in-a-generation opportunity, that this time really is different. That feeling shows up in every major market cycle. Confidence turns into certainty, and risk starts to feel invisible. Sometimes innovation really does change the world, but markets still move in cycles, and when prices move too far ahead of reality, they tend to come back down. The real issue isn't fear. It's having too much money in one place. Even if you own a lot of different funds, if they all move with the stock market, you still have all your eggs in one basket. And when that basket drops, everything inside it drops too. That's why the truly wealthy think about diversification differently. Research from KKR shows that the average investor keeps about 95% of their portfolio in traditional assets, stocks, bonds, and cash. But high net worth investors, they have nearly half of their portfolio in alternatives like private equity, venture capital, and real estate. They understand something most high-income earners were never taught. Real diversification isn't about owning more funds, it's about owning assets that don't rise and fall with the stock market. And that's where real estate comes into the equation. Because unlike stocks, it's not just something you own and hope for the best. Real estate gives you something the stock market never will: control. And that control makes all the difference. In the next part, I'll show you exactly how that control gives you an advantage and why it's the single biggest reason real estate has outperformed for generations. This is where real estate separates itself from every other asset class. With stocks, you're a passive participant, a spectator. You buy shares, you wait, and you hope the price goes up. You can't call Apple and tell them to innovate faster. You can't influence earnings. You can't control the outcome. With real estate, it's different. You can improve the property, you can raise rents, you can reduce expenses and force appreciation. You're not waiting for value, you're creating it. One of our students, a radiologist, says something on a coaching call that really stuck with me. With stocks, I just cross my fingers and hope. With real estate, I can actually do something about it. She bought a short-term rental for $500,000. She made smart, targeted upgrades to the property. Nothing over the top, just improvements that mattered to renters. Within 3 months, the property's value increased by 30%. That's $150,000 in added value, pushing the property's value up to about $650,000. And that wasn't the only result. She also generated a 20% cash-on-cash return. That means she invested $175,000 of her own capital, and the property produced $35,000 per year in cash flow after expenses. In simple terms, for every dollar she invested, she earned 20 cents in cash flow every year. Value up 30%, cash flowing 20% in just 90 days. And it happened because she could take action, not because the market got lucky. And that's the difference. That's not luck. That's control. You can't force appreciation with stocks, but with real estate, you decide when to renovate, when to refinance, when to optimize operations, and how to grow the asset's value over time. That level of control changes how risk works. You're no longer dependent on market sentiment or headlines. You're working with an asset where your decisions matter. And that control is exactly what allows real estate to protect you from two of the biggest threats to your wealth: inflation and taxes. That's what we'll look at next. Let's start with inflation. Inflation is quietly stealing your wealth, and most people don't even realize it. Inflation quietly erodes purchasing power year after year. You probably heard that the stock market averages around 10% annually. But once you adjust for inflation, that number drops closer to 6.5 to 7% over the long term. And when inflation spikes like it did in 2022, reaching around 9%, real returns can turn negative, even if markets appear flat or slightly up. That's the part most people miss. Now compare that to real estate. Real estate tends to move with inflation, or even ahead of it. When prices go up, you can raise rents. Your tenants pay more, but your mortgage payment stays the same. That means when rents increase, those additional dollars flow directly to your bottom line. Inflation doesn't hurt you, it actually works in your favor. Now that's one layer of protection. Now let's talk about taxes, because for high-income earners, taxes are often the largest expense over a lifetime. With stocks, taxation is straightforward and constant. You pay taxes on dividends, you pay capital gains when you sell, you're taxed every step of the way. Real estate operates under a completely different set of rules. Through tools like bonus depreciation and cost segregation, real estate allows you to create paper losses, even if your properties are making money. Those losses don't just offset rental income. In many cases, they can also reduce the taxes you owe on W-2 income, 1099 income, or other income sources, depending on your situation and how the investment is structured. Now think about that for a second. While the property is generating cash flow, appreciating in value, and keeping pace with inflation, it could also be reducing your tax bill at the same time. That combination is rare. Stocks don't do that, and bonds don't do that. Only real estate gives you income that adjusts with inflation, tax strategies that let you keep more of what you earn, and an asset you can actively manage and improve. That's how you protect and grow your wealth. And it's also why buying the wrong real estate can be so damaging, because when you don't have cash flow or control, those protections disappear. That's exactly what I learned the hard way early in my investing career, and what we'll talk about next. When I first started investing, I made the same mistakes a lot of people make. I bought land, I bought expensive condos in Seattle and Vancouver. They were great locations, beautiful properties, but they didn't cash flow. At the time, I was betting on appreciation. I thought, prices always go up. Then 2008 hit. The market crashed. Those properties lost value quickly. Some took nearly a decade to recover, and some never fully did. That experience taught me one of the most important lessons of my investing career. You can't just buy any real estate and expect it to build wealth. Bad deals don't just hurt returns, they can set you back years. They drain your savings, they drain your energy, and they drain your confidence. What's worse, they can convince you that real estate itself doesn't work, when in reality, the problem was the deal. The truth is, successful real estate investing is a skill. It's not about luck. It's not about timing the market. It's about knowing how to evaluate opportunities. You need to understand what actually makes a property cash flow, how to identify value-add potential, the things you can improve to force appreciation and get a property to go up in value, and how to structure an investment so it works with your tax situation, not against it. That's the difference between a property that looks good on paper or on social media, and one that actually builds wealth. When my wife and I finally got serious about learning how to invest the right way, everything changed. We stopped chasing appreciation. We started focusing on cash flow, equity growth, and being tax efficient. Once we made that shift, our wealth started to compound. That's when we started building real financial security, and more importantly, options. The option to step back, the option to say no to things that don't serve us, the option to buy back our time. And that's something no stock ticker can give you. And stay with me, because in a minute, I'll share the one phrase I hear from every successful investor, the one that almost always comes with a feeling of regret. Every real estate investor I know, every single one, eventually says the same thing: I wish I'd started sooner. And I feel exactly the same way. Because once you buy your first property, once you see how this actually works, everything changes. You see how cash flow shows up month after month. You see how equity builds, even when markets are uncertain. You see how depreciation and tax strategies reduce what you owe. And you realize something important. This isn't magic. It's not luck. It's a skill set. And like any skill, it's absolutely learnable. And here's the truth. What stops most people isn't money. It's fear. Fear of making a mistake, fear of losing money, and fear of not knowing enough. So instead of acting, they stall. They read more books, watch more videos, listen to more podcasts, trying to eliminate uncertainty before taking a step. But information alone doesn't build wealth. Action does. You'll never have all the answers before you start. And that's okay. None of us did. One of our mentors says, never leave the scene of a decision without first taking a specific action towards its realization. If something in this video resonated with you, if you've decided that you want more control over your finances, more protection for your wealth, and more income outside of your job, the next step is simple. Take action. Book a free strategy call with our team. It's easy, it's free, and it's a concrete first step. On that call, we'll help you get clarity on your goals, show you what's possible with real estate, and outline what the next steps could look like for you. Don't let fear or indecision cost you another year. The next market crash isn't an if, it's a when. The only real question is, will you be prepared when it happens? You don't need to replace your entire portfolio overnight. You don't need to quit your job or become a full-time real estate investor, but you do need to start learning, and more importantly, start taking action. Because when the next correction comes, you want to be the one whose investments keep paying you, not the one watching years of savings disappear on a screen. The best time to start was yesterday. The next best time is today. Invest in your financial education. Build income you can control. Protect your wealth so when the market turns, you're ready. Thanks for watching, and I'll see you in the next video.